All right, let's talk about one of the most fascinating and frankly terrifying strategies in all of finance: short selling. It's a way to play the market that flips everything you probably know about investing completely on its head. I mean, we all learned the first rule of investing, right? Buy low, sell high. But what if there was a way to make money when a stock's price goes down? That is the powerful and incredibly dangerous idea at the very heart of short selling. So, how in the world do you actually bet against a company? It feels totally backward, but believe me, it is a very real and very active strategy in the financial world.
Now, right off the bat, you've got to understand this is not your average, everyday investment strategy. This is really the playground of the big guys. We're talking hedge funds and other professional investors. For them, it can be a tool to find companies they think are overvalued, but it requires some serious risk management. And as we're about to see, there is a very, very good reason for that.
Okay, so how does this whole thing actually work? Well, the mechanics behind it are, believe it or not, pretty straightforward. Let's just walk through the 4 key steps. So, it all happens in 4 moves. First up, you borrow shares of a stock that you don't actually own from a broker. Step 2, you immediately sell those borrowed shares on the open market. Third, you wait, and you hope the stock price falls. And if it does, you buy those exact same shares back. And finally, you return the shares to the broker you borrowed them from. Simple, right? If you bought them back for less than you sold them for, the difference is your profit.
Let's make this real with an example. So, picture a stock. It's trading at a nice, round $100 a share. But you've done your research and you are just convinced it's way overvalued and it's about to take a nosedive. So you decide to short 25 shares. You borrow them and sell them immediately. At $100 a share, that puts $2,500 into your account. But, and this is key, that's not profit yet. Remember, you still owe your broker 25 shares of that stock.
And what do you know? You were right. The company puts out a bad earnings report and the stock gets hammered. It drops all the way down to $50. This is the moment you were waiting for. So it's time to close your position. You go back into the market and you buy those 25 shares. But now, at this new, lower price, it only costs you $1,250. You return the shares, and that $1,250 left over, that's your profit, minus some fees. It's the perfect trade. You bet against the stock, and you won. At this point, you might be thinking, wow, this sounds like an amazing strategy. But this is where our story takes a very, very sharp turn, because there is a fundamental and honestly a terrifying flaw at the very core of short selling. I mean, that whole profitable scenario we just walked through, it seemed pretty easy, right? But it all hinges on one little thing: being right. So what happens if you're wrong? What happens if the stock price doesn't go down? What if it goes up? This right here, this is the most important concept to grasp. When you buy a stock, the most you can possibly lose is what you put in, right? If it goes to zero, you lose your initial investment. But when you short a stock, there is absolutely no ceiling on how high its price can go, which means your potential loss is, and this is not an exaggeration, literally infinite. And that whole unlimited loss thing, it isn't just some scary theory they teach in finance class. There are a bunch of real-world ways that a bad bet can turn into an absolute financial disaster. The most famous, or maybe infamous, of these is the short squeeze. This is like a feedback loop from hell for short sellers. What happens is the stock starts going up, which forces short sellers to buy back shares to cut their losses. But all of that buying pressure just pushes the price even higher, which traps even more short sellers, creating this frantic upward spiral. And the pain doesn't stop there. You're constantly bleeding cash from margin interest on the shares you borrowed. Oh, and if the company pays a dividend while you're shorting it, guess what? You have to pay that dividend out of your own pocket to the person you borrowed the shares from. And maybe worst of all, your broker can just decide they want their shares back at any time, forcing you to buy them back at the absolute worst possible moment. Of course, you can't talk about short squeezes without bringing up the most spectacular example in recent history: GameStop. Back in 2021, some very large hedge funds had bet billions of dollars that the company would fail. But then, a huge community of individual investors, mostly organized on social media, started buying up the stock. The result was absolutely explosive. The price just launched from around $17 a share to almost $350 in just a matter of weeks. It was the definition of a short squeeze. And the outcome for those professional short sellers? It was a catastrophe.
One huge hedge fund, Melvin Capital, lost a mind-boggling 53% of its entire value in January 2021 alone. It's just a stunning cautionary tale.
So after seeing the potential for profit on one side and the catastrophic risk on the other, you have to ask the big question: is short selling ever really worth it?
You know, there's a saying that really hits the nail on the head here. The idea is that because the market's long-term trend is to go up, when you're shorting stocks, you are always swimming against a very powerful current. So here's the bottom line. While shorting a stock might seem like this really clever way to play the market, the risks are just immense. They're unique. That potential for infinite loss makes it a game that, frankly, most people should probably never play. And it really leaves us with this one final question to think about. In a market that is, over the long run, designed to go up, is betting against it ever truly worth the gamble when the risk you're taking is literally infinite?